Hey everyone, and welcome back to WealthWise. What if the safest investment in the world, the foundation of pensions, retirement accounts, and even entire countries, is starting to break? It sounds dramatic, but consider this. Here in the US, as we head through 2025, our interest payments on the national debt are on track to exceed our entire defense budget. If we don't get a handle on this, what money will be left for anything else? This isn't abstract theory. And when Jamie Dimon, CEO of JP Morgan Chase, managing nearly $4 trillion, warns of a crack in the bond market and predicts panic, we need to listen. He's not alone. Overseas, Japan's 30-year government bond has lost roughly half its value since 2019, down about 45% recently, as interest rates surged. This has already caused massive unrealized losses for Japan's biggest life insurers. Here at home, the U.S. national debt is north of $38 trillion. Our debt-to-GDP ratio? Around a staggering 130%. Our yearly deficits are pushing above 6% of GDP, more than double the 3% level economists generally consider sustainable for a healthy economy. So if Japan, once a pillar of financial stability, is flashing red, and a top banking CEO is sounding the alarm here, it's time to pay very close attention. Because if the bond market truly cracks, it could threaten far more than your investments. It might unravel the entire global financial system. Today, we'll break down what's happening, why it's critical, what it means for your money, and how I'm personally approaching this. Let's get into it. Alright, today we're diving deep into economics, but stick with me. Understanding this is key because it all circles back to the federal deficit, national debt, and at the center, the bond market. Quick recap: when bond prices fall, their yields, or interest rates, go up, and vice versa. Like a seesaw. The problem? These interest rates are rising at a historic pace. The 10-year Treasury yield, a global benchmark, shot up from under 1% in 2020 to near 5% by 2025, the fastest jump in over 40 years. This puts huge pressure on banks, governments, and institutions. Why are rates up? When investors doubt a country's ability to pay back its interest, they demand higher yields for the added risk. It's like lending to a less reliable friend, you'd want extra compensation. Rising yields are often the first warning sign. And these signs are flashing not just in Japan, but here at home too. To grasp how we got here, I want to share insights from economist Lyn Alden, author of Broken Money, highly recommended. Her research explains why we're trapped in this cycle of rising debt. First, look at this chart: unemployment in red, government deficits in blue. Normally, low unemployment means smaller deficits. But since around 2017, even with low unemployment, deficits climbed fast. Our yearly deficit is around 6% of GDP, double what's considered healthy. It's like the government spending as if we're in a recession, even when job numbers say the economy is strong. This means we're borrowing at an emergency pace during good times. More borrowing means more bonds, nervous investors, and rising interest rates. It's a trap. Next, real interest rates versus gold. Real rates are bond yields minus inflation. Historically, high real rates meant investors bought bonds. Low or negative real rates pushed them elsewhere. But recently, from 2022 to 2023 onwards, gold prices have stayed strong or risen even as real interest rates tried to climb. This decoupling suggests investors aren't rushing back to bonds. They're shifting to scarce assets that can't be printed or devalued. It signals doubt in the current debt-based system. This third chart compares private debt, businesses, people, in blue, and public, government, debt in red. Historically, private debt grew faster, except in recessions. But after the 2008 crisis, government debt growth started consistently outpacing private debt, even during expansions. Our government is borrowing like we're in a crisis, even when we're not. So, who buys all these new bonds when debt is already so high? Investors worry if it can be repaid without just borrowing more. Lyn Alden's fourth slide is a showstopper. Red is the U.S. federal debt-to-GDP ratio, blue is interest rates. In the 1980s, debt was 30% of GDP, but interest rates were very high. Since then, debt has soared while rates generally fell, making borrowing feel manageable. But now, we've hit a turning point. Rates can't go much lower and have started rising again because our debt is the highest since World War II, over 130% of GDP. Now, when rates rise even a bit, interest payments on existing debt skyrocket. It's like mortgages. Grandpa afforded 15% interest because houses were cheap. When houses cost a fortune, even 6% is crippling. That's our national situation. Our mortgage amount, debt, has never been higher, so we can't sustain these higher rates. That's why Jamie Dimon warns of trouble if the bond market cracks. Why does government keep borrowing? Look at the Social Security Trust Fund. It peaked around $3 trillion around 2017 but is now dropping fast, expected to hit zero within a decade. Why? Demographics. Baby boomers are retiring. For years, government collected extra from boomers, investing it mostly in U.S. Treasury bonds with low real returns. Now, as boomers retire, government sells those bonds, draining the trust. If it runs out, government can't just stop paying. Choices: raise taxes, cut spending, both politically toxic, or borrow even more, deepening the cycle. This demographic shift makes the debt problem structural, not temporary. This debt Ponzi chart shows total U.S. debt, blue, and the monetary base, orange, Fed printed money. The difference is system leverage. Since the 1960s, total debt has only dipped once, during the 2008 crisis, a tiny dip that nearly broke the world. In the last 110 years, Lyn says debt has deleveraged only in the Great Depression and 2008. In 2008, the economy was levered 50-1. Today, total debt is near $100 trillion. Seriously reducing it risks collapsing the system, which relies on ever-increasing debt and money printing. The catch: more printing means inflation risk. Investors then demand higher bond yields. It all circles back to the bond market. Have we been here before? Yes, in the 1940s after World War II. This 100-year chart shows how U.S. debt shifted between government, blue, and private, orange. In the 1920s, 30s, private debt boomed, then busted, Great Depression. Government then borrowed massively for World War II, and government debt skyrocketed. How did they fix it? Not by paying it off directly. They used financial repression, keeping interest rates artificially low, encouraging inflation to erode debt's real value, fostering growth, and gradually shifting the burden to the private sector over decades. But today is different. In the 1940s, the U.S. had 1. Room to lower rates. We don't. 2. Strong demographics, baby boom. Ours are aging. 3. Unrivaled industrial power. Now, fierce global competition. 4. Inflation wasn't a pre-existing problem. It is now. The tools used then are mostly unavailable or too risky now. The system is strained. So, what can you do? This is my personal approach, not financial advice. Please do your own research. For me, it's about diversification and resilience. 1. U.S. stock market. Via ETFs like VTI, I believe in long-term U.S. innovation. If we navigate this, quality companies thrive. More money printing can also inflate stock prices. 2. Hard assets, Bitcoin, gold. If the system fractures or inflation persists, scarce assets like Bitcoin, my preference, or gold become more valuable. Owning something central banks can't create is key. 3. Real estate. Tangible property can hedge against inflation and provide utility. 4. Cash/short-term bonds, liquidity for opportunities or emergencies. Each bucket is roughly 20 to 25% of my net worth, adjusted as needed. My conviction: not owning hard assets now is riskier than owning them. The old playbook may not be enough. If you're new to assets like Bitcoin and want to learn to approach it safely, I have resources on the WealthWise platform. Link in the description. These are complex, unsettling times. But knowledge is power. Understanding these dynamics is the first step to informed decisions. The bond market stability underpins everything: your mortgage, retirement, even national standing. I hope this was valuable. What are your thoughts? How are you navigating this? Share in the comments. If this video helped, please smash that like button, it helps the channel. And if you haven't, subscribe to WealthWise and hit the bell for more deep dives. Thanks for watching. Stay informed, stay vigilant, stay wise. I'll see you next time. Take care.